Good morning, everybody. This is Hunter Satterfield, the Chief Investment Officer and one of the partners here at Kane Waters. As always, today I am joined by my fellow partner, Brian Bortz, who also is the head of our investment committee, and then Brad Sanders, the Managing Director of Tectonic Advisors. This is your February market update. For the month of February, the S&P moved higher at 5.3% for the month. Global stocks are up 4.2%, and then domestic bonds and global bonds were both off, down 1.4% and 1.3%. And Brad, I definitely want to come to you on what's going on with the fixed income markets and when we feel like we can get some of that back and start moving higher. But before we do so, Brian, I want to come over to you. I mean, this is another month of sort of what you're calling mixed signals. And we've seen that obviously over the past 12 to 18 months. Can you talk a little bit about what we're seeing and thinking through on those mixed signals with both the equity and fixed income markets?
Yeah, thanks, Hunter. You're exactly right. The market continues to send mixed signals. And if you are listening to this video, I want you guys to understand, and maybe write a couple things down, but understand that the market's going to give you pluses and minuses all the time. The ones that I wanted to highlight for this month, the national debt is up $3 trillion since the debt ceiling was raised or suspended last June. It's a massive increase in our national debt, $3 trillion. And the interest payments on that debt are now annualizing out at over $1 trillion, which is up 98% over the last 3 years. So all that sounds horrible and gloomy and terrible. But then you look at the S&P, and the S&P was up 21.5% for the last 4 calendar months. That's happened 15 times in our history, where the S&P is up 21.5% or more in 4 months. Each time that that's happened, each of those 15 times, the S&P was even higher 6 months from now and even higher a year from now. So, there's mixed signals here. There's pluses that you could look at. There's minuses that you can look at. And really what I'm concerned with, and I want to kick it over to Brad, is just to say, with all the national debt that's hanging out there and the looming of maybe closing the government again, which never seems to happen on the 12th hour, but what's going to happen with fixed income here as we go forward for the rest of this year?
Yeah, exactly. I think that's a great segue over to you, Brad, because I mean the reality is that we've dealt with fixed income being very choppy for a while now, and I think a lot of our clients are starting to ask, when are we going to see this rebound? So you want to talk a little bit about that?
Yeah, I mean, I think the short and sweet answer is when the Fed eases. I mean, honestly, when you buy fixed income, you can take one or two different kinds of risk or both. You take credit risk or interest rate risk. And I guess the good news is there's not a lot of credit risk out there once you get past maybe the commercial real estate problem that I think we're all aware of at this point, post pandemic. If you kind of move out of that and you look through corporate balance sheets and you look through municipalities, like credit, generally you would expect to see some sort of credit issue if you've had a bond market that's performed this poorly since 2022, and we don't. So really, then you can just turn your sole focus to, okay, it's interest rate driven. And I think the mixed signals from the Fed, I think what the bond market's struggling with is the fact that it's becoming pretty clear that there's a pretty decent chance we might not get any rate cuts this year. The market's priced in 50 basis points by May. That would be predicated on us getting a quarter basis point this month. Well, that's not going to happen. That's been made very clear. So the market's already priced in, 50% too many cuts by the May meeting. And where inflation is and where growth and employment are, they don't really support easing at this time. And the Fed's keenly aware that in the 70s, they eased too early and we got that secondary wave of inflation. So this is just the first time in like 25, 30 years where we've dealt with an inflation problem. And you have the term structure of the bond market is such that, you've got the front end at 5.25%, you've got the 10-year at 4%, 4.2%, somewhere around there today. You're not going to get a significant bond move where prices come back up until you get that first rate cut. Then I think the good news is I think when it happens, the bond market's going to price in a bunch of cuts like really fast before they even happen. And then you're going to get that kind of, because of what the Fed's done, all this waffling back and forth, there's no catalyst. Like if you're, we're buying fixed income for our clients because we're sitting here like there's never been a better time to buy mortgages in my lifetime, basically. You can buy a portfolio of mortgages issued prior to 2022 that have a 3% coupon rate that are discounted at 80 cents on the dollar. They've got a 7% yield. And all you have to do is wait for the mortgage rates to come back down. Those are going back to par, and there's no prepayment risk. Nobody's refining those. Why would you refi and like get a mortgage double that price, right? So there's all this opportunity, but to the layman out there, they're like, I can just go put my money in a 6-month T-bill and get 5.25. Why would I take any of this bond market risk when there's no rate cuts coming, or ostensibly they keep saying they're going to, and we rush in and the bond market pops and then it all goes away. And so I think once the Fed takes that first action, we're going to get the relief in the bond market that we want. And to Brian's point, it's remarkable that the equity market's done what it's done with the bond market not playing ball. So I think that you can kind of read through that and think we've got a pretty good setup for a good market once we get, rates kind of coming back and getting monetary conditions easing. Because the equity market's already at a high, and then you've got that, carrot kind of dangling out there. I just think it's going to keep getting pushed out longer and longer. And if we get into the fall, the Fed's going to be very reticent to start cutting policy right before an election. They're just not. That's not going to be. They're almost going to have to be forced to do it at that point. They're not going to voluntarily do it, in my opinion.
Yeah, no, that's great. Thanks, guys, for the feedback on that. And, we've got a lot coming up this next month as we near the end of Q1 with Super Tuesday and again, Fed meeting and whatnot. So we'll be back in front of you at the end of March with where we stand heading into Q2. Thank you so much.